Good afternoon, ladies and gentlemen, and thank you, first of all, to you and ICMA for inviting me to speak here today. And thank you for all of you who are bearing in this hall with us while outside the sun is shining and summer has arrived. So I'm very grateful for your attention. Let me start by the fact that geopolitical tensions continue to be a determining factor behind much of the recent volatility in financial markets. Clouds are certainly on the horizon when it comes to the economic outlook and inflation expectations. Yet, despite all of this, our capital markets have remained, maybe surprisingly, but positively resilient. This resilience is of utmost importance. Capital markets act as a stabilizing force for our economies. Without that stability, the system can quickly be blown off course. Europe faces significant financing challenges to support an innovative, competitive, and low-carbon economy, and I think you're having exactly the same debates here in the UK. To meet them, we need strong, reliable capital markets that can hold firm under pressure, well anchored in times of turbulence, yet able to raise their sails when needed. This requires further integration, on the EU side at least, of our capital markets, so that liquidity can grow, companies can scale, and funding can move seamlessly across borders, or, with the sailing analogy, across oceans. Only then will we be able to support investment, innovation, and growth. Our ambition is clear: to create a capital market ecosystem that is not only resilient, but also deep, integrated and able to operate at scale. This is precisely where the Savings and Investment Union, and in particular the Markets Integration and Supervision Package, would be instrumental in delivering on this ambition. Let me begin by stating very clearly that obviously ESMA strongly supports the aims of the Savings and Investment Union and is also behind and committed to do what we can to make the Market Integration and Supervision Package work. It builds on a shared assessment that despite our solid framework and the capital available in Europe, our markets have not integrated deeply enough. One reason is structural. In trading and post-trading, the landscape remains fragmented, with many infrastructures still largely organized along national lines. On the trading side, we understand that the absence of a dedicated framework for pan-European groups of trading venues hinders their capacity to operate across member states. The proposed PMO regime, or pan-European market operator regime, would be therefore a valuable optional alternative for those trading venue operators seeking a more efficient and integrated pan-European model. In the post-trade environment, the number of CSDs adds to settlement costs, reduces investor choice, and makes cross-border transactions operationally quite complex. That is why measures to reduce fragmentation and improve integration are both timely and necessary to support settlement efficiency and to enhance market liquidity. In practical terms, connections to CSD hubs and reciprocal links can ease investor access to a wider pool of securities. And for CSDs that settle in a T2S-supported currency, joining T2S can foster stronger interconnections across EU financial markets. On the clearing side, promoting greater interoperability will help to further reduce fragmentation, linking financial market infrastructures, and ultimately helping to increase liquidity. Fragmentation is not only an issue when it comes to market operations, though. It can also be an issue when it comes to supervision. Even small differences in how rules are applied and practiced can create real operational hurdles. For the most important pan-European infrastructures, a more centralized supervisory model would, in our view at least, improve efficiencies, ensure more consistent oversight, and give a clearer view of risks across the whole of the European system. For many major cross-border market infrastructure players, more centralized supervision is therefore a welcome step, and they call for this step to be taken quickly. Certainly, FESE and each did that again yesterday in a joint statement. From the ESMA side, we stand ready to embrace these new targeted responsibilities. We've built up our supervisory experience over the last 15 years, and I believe we've grown over time into a mature risk-based supervisory authority that is able to manage complex mandates, build up expertise, and deal with tight deadlines and some challenging situations. This gives us confidence that as ESMA we can deliver. Of course, in certain areas we have more direct expertise in-house than in others. I'm not pretending that building up to take on the currently proposed additional mandates would not be a certain challenge. But I do believe we have shown that we can meet such challenges. Do I believe that we are committed to working with the national authorities to allow for a smooth and effective transition to any new EU-level regime. Together, we can build the necessary structures, the required expertise, and the appropriate processes to provide EU-level supervision that is effective and efficient, as well as proportionate. Supervision that ultimately supports well-functioning and integrated EU capital markets, markets with lower costs, deeper liquidity, and better outcomes for issuers and investors. That is clearly the ultimate aim that we are going for. Advancing the market integration supervision package is therefore an absolute priority, but we should not lose sight of other equally important milestones for deep and efficient capital markets. A key building block in supporting liquidity formation and price discovery is the development of consolidated tapes, as was just discussed here. And this is finally taking shape also on the EU side. We are confident the consolidated tape can improve transparency and help reduce fragmentation. This also reflects a shared recognition on both sides of the channel of the importance of high-quality market data for well-functioning capital markets. Alongside enhancing transparency through consolidated tapes, we've agreed on a near-term milestone that should help improve market efficiency, the move to the shorter settlement cycle of T+1. A shorter cycle should allow us to free up capital more quickly, reduce risks, and again, support liquidity. The EU and the UK and Switzerland actually have set the 11th of October next year, 2027, as the date for moving to T+1. This European geographical alignment is important to avoid fragmentations across the continent and to ensure a smooth transition for market participants operating internationally, like so many of you here in the room. We are now in the preparatory phase, and it is crucial that everyone is aware of what is needed for the transition and is getting ready. Anticipation and preparation are key factors to ultimately make us succeed in the transition to T+1. While we work on these more near-term or medium-term priorities, we must not overlook the long-term. Technological innovation will modernize capital markets, and tokenization has the potential to be certainly transformative, as again was just mentioned. Streamlining issuance, trading, and settlement, improving transparency and reducing operational frictions. It could also lower firms' operating costs by embedding compliance and reporting into digital assets, while giving supervisors new tools for real-time oversight. The EU's DLT pilot regime has been illustrating how tokenization can be applied in real-world situations by allowing DLT-based trading and settlement systems to be tested with targeted regulatory exemptions. As ESMA, we support efforts to further embrace innovation, aided by improving the DLT pilot regime where we can and updating post-trade regulations, all of which is also in the market integration package. Our regulatory framework must keep pace with the market developments, and create the conditions for new technologies to take root and to be able to scale without creating new forms of fragmentation as we are seeing in some of our traditional markets. None of these efforts, whether integration, infrastructure improvements, or innovation, will deliver their full benefits, though, without an efficient and effective regulatory framework. Over time, detailed and duplicative requirements have built up into administratively complex rules across the EU. This creates costs, reduces agility, and ultimately limits firms' ability to operate across borders at scale. This is why we need simpler, more coherent rules that support integration and market efficiency, while at the same time ensuring resilience. Achieving meaningful results takes time, but certainly we are fully committed. And to translate that commitment into real action, at ESMA we are taking a holistic approach, looking at the policy framework, at supervision, and at data at the same time. Let me briefly explain what that means in practice. First, on the policy framework, we are identifying key areas where changes can reduce complexity and improve clarity, consistency, and proportionality. And one example of that is what we've done with our recent report on the investor journey. Second, on supervision, we are strengthening our risk-based approach, both in the areas where ESMA itself is a direct supervisor already, and by embedding common risk-based principles across ESMA and the national competent authorities. The goal here is to focus supervisory intensity where the risks are highest and reduce unnecessary burdens elsewhere. Third, on data, we are reviewing MiFIR, EMIR, and SFTR in the reporting space to eliminate overlaps, harmonize definitions, and discontinue certain data flows. We are also working on integrated funds reporting. Our objective is to reduce operational burden by applying the simple principle, report once, use multiple times across multiple authorities. Taken together, all of these strands of the reform, integrating markets and strengthening supervision, delivering on the changes that would allow deep and efficient markets, embracing technological innovation, and simplifying the framework, are all mutually reinforcing. And as the EU, we have a clear opportunity to strengthen our capital markets by integrating more, supervising more consistently, and embracing innovation. At the same time, we must simplify where we can so that the framework remains effective, proportionate, and competitive, without compromising on the ultimate safeguards that underpin this important trust in our markets. And I think that is very much a common journey on both sides of the channel, and very much a common journey between the public authorities and all of you as market participants. So let's move on that journey together. Let's set sails and go. Thank you very much for your attention.